Thanks everyone for the opportunity to speak. So there are clear signs now that the markets are frothy, to say the very least. The crypto space and NFT space, which is a decent proxy in my opinion for the degree of speculation and risk tolerance in markets, was up an enormous 96% in aggregate in 2024, with many new digital tokens created pretty much out of thin air. The most famous, perhaps, for its offensive name was the Fartcoin at the bottom there. Now over 1 billion of market cap. That's billion with a B. Overall coin market cap now in the trillions with a T. And for those paying attention over the last few weeks, through two digital companies, one I believe is called the Fight NLC, which collectively holds some large percentage of the Trump digital coin and token supply. The US president's net worth could well have skyrocketed by up to 50 billion. That's likely a 10 times move in his net worth in just a few days. So quite remarkable. But it pretty much sums up what is a normal and well-functioning capitalist democracy. No sarcasm intended there. So you can argue that crypto is a sideshow, but I think that would be naive. It's a symptom of speculative activity. It's also prevalent in equities, especially in the more loved areas of the equity market. For example, US equities. It's interesting to note, for example, how the correlation between Bitcoin, you see here, and the US equity market has risen over the last cycle. Not so much non-US equity, but very much so in terms of the US equity market. That correlation has risen a lot. I was very much drawn to this quote by Matt Levine at Bloomberg, which I think sums up the mood pretty well. Investors are up for more fun. If you launched Enron today, he says, even without a real business, the stock would likely go up because that is the funnest outcome. There's an unseriousness to markets that you only really see at frothy tops and ahead of some lean years for investment returns. So one of my recommendations as we stand today would be to be cautious. We're not in an environment that offers asymmetric upside opportunity, very much the opposite in my view. So on to performance. This is the 1, 3, and 5 year performance of the global fund in US dollars. And this is the numbers in Rand. So absolute returns have been reasonable over the last business cycle, 1, 3, 5 years. But the indices themselves have been absolutely exceptional. Now we live or die by what we add over and above the averages. So this has been a disappointing cycle for us. We tend to think about performance in a longer term context. So we very much expect to deliver excess returns above indices over a full business cycle, which I think of as roughly a 7-year period. The chart shows 7-year cycles back to inception, blue being the global fund in US dollars, and orange being the world index. Our global fund has beaten the index in every cycle until we hit this most recent one. So the latest business cycle, which is 2018 to today, has been weak for us, especially in relative terms. To have confidence that the next cycle will be less like the last one and more like a kind of normal cycle for us, you have to get a sense for the drivers. What went wrong over the last cycle, and will the same things happen going forward? So in that regard, there are a few questions I'd be asking. Number one, are markets becoming more efficient today than they used to be? Number two, if mispricings do exist, which mispricings being our lifeblood as investors looking for excess returns, will we be able to find them? And finally, is there some other dynamic at play that we need to worry about? So focusing on the first question, I touched on this earlier, but it's hard to argue that markets are efficient when investors are seemingly now investing on the basis of fun. This is Fartcoin again. Perhaps the utility function has changed in markets and making money is no longer the object. Or perhaps effectively we've been in a bull market for too long. But more seriously, we do track the level of internal inefficiency within global equity markets. So the blue line on this chart is sort of a proxy for that. So the higher the line, the more mispricings there are to exploit within equity markets. If you think of equity markets as 3,000 stocks within a broad index or around the world that we have to choose from, what degree of mispricing do we see within those markets? And many large-scale mispricings have come and gone over the years. So the Japan bubble in the late 80s, the TMT bubble in the late 90s, the forced liquidations around the GFC led to some very, very big mispricings. All of those pale in comparison to the one we saw through COVID. It's truly off the scale. So if anything, I think the peaks are getting higher. That is, market mispricings are getting larger, not smaller. And there are reasons for that, which we may hit in the Q&A, but I'll leave that observation sitting there for now. Level of mispricings in markets today, reasonably pronounced. So if I'm saying that market mispricings are alive and well, and possibly getting more pronounced over time, why have we not done better over the last cycle? Well, the good news is that we collect a lot of data. We always have, right back to inception internally, and we collect this data on the kind of drivers of performance. And one thing we know is that finding mispricings hasn't been the main issue over the last cycle. So this is the performance of our engine, as we term it. That is the stock selections of our key investors and stock pickers around the world. That's in the blue line. It provides a rough idea of whether we've kind of delivered stronger or weaker return versus the average stock in the world index. So that's the orange line. That's the average performance of the stocks within our opportunity set, which contains around 3,000 equities globally. And you can see that the excess return has been there even over the last cycle. And this is internal data, so you can take our word for the chart, or you can look at the positive excess returns that have come through across our other strategies, all choosing from the same pool of equity picks coming from our engine. That's the International Fund, Global Balance Fund, Japan Fund, EM Fund, all delivered reasonable excess return, even over the tough previous cycle, which is consistent with since inception performance. So clearly there's something specific here for global that's going on, and there's some other dynamic at play. And there's actually been two main drivers over the last cycle of subpar relative performance. First has been portfolio construction. I won't spend a lot of time here, as I realized a little bit too late that this was addressed last year, I think, to some degree, and the year before in this forum. But suffice to say that between 2017 and 2022, we basically failed to translate the value created by our engine into excess returns for clients, and that was a portfolio construction issue. And in 2022, we addressed this, making some changes. In addition, we've put a big effort into the technology side to ensure that valuable insight coming from the engine is captured by the portfolios and delivered to clients. One tool you can see here showing recommendations from the analysts, which recommendations are the top ones, any changes in intrinsic value, and any nudges by our decision analytics team regarding behavioral biases that we all carry to some degree as investors. So lots of work and improvement on the portfolio construction side. And I very much believe the fund is now well placed to carry the value created in our engine through to clients over the next cycle. So the second reason for tough performance during the previous cycle has been less within our control. So going back to this chart showing the performance of our stock selection, this is our stock selection engine. All stocks picked by our analysts is the blue line. What we're showing in the orange line here is, as I said earlier, is the average stock, the performance of the average stock. The average stock, after all, is the best reflection of our opportunity set, which is those 3,000 possible choices. What's been rather dramatic over the course of the last 7 years is the degree to which the average stock has lagged the world index itself. So that's the world index in red. So having performed very similarly up to 2018, you see the red line and the orange line up to this point were pretty similar. So the index was similar to the average stock. Since 2018, the index has gone on to deliver a whopping 26% more return cumulatively than the average in the average across all of the stocks since 2018. So it's a massive difference and extremely unusual. You can think of the index as just another portfolio. So there are 3,000 stocks, all those options, and the index is one way to construct a portfolio from those companies. Another way of constructing a set of positions it's just one of those sort of ways, and there are tons of other ways you can do it. And what's striking about the last 7-year cycle is just how successful that specific construction has been, weighted by company size, a very simple rule. Here, what we've done on this chart is simulate 10,000 other potential ways to build a portfolio from the 3,000 stocks in the world. And the world index has beaten 80% of them. So it's been a very, very extreme environment. That's quite unusual. In the cycle before that, 2010 to 2017, the world index way of constructing a portfolio was a little bit below average. And in the cycle before that, 2003 to 2010, the index was one of the very worst possible portfolios you could have constructed. So you can see a massive variation in how the index stacks up versus all the other possible portfolios you could build. And that leaves one to wonder, what will the next 7 years look like? Will we see another decade where the passive indices are likely to handsomely beat most other ways of constructing a global portfolio? Of course, the answer is we don't know, but we do have clues. The index wins, of course, when the biggest companies are the best investments. And we've seen periods like this before, and enduring periods like this before. They're not common, but they have happened. Two in particular stand out. One was between 66 and 73. And that was a period in which the index annihilated most other portfolios and most active managers by extension. A more recent example was 93 to 2000. So each of these periods have one common feature, and that is that the big stocks, the drivers of the index, started the period relatively cheap before becoming relatively expensive. So here we plot the relative attractiveness of the biggest 10% of stocks in the world index. They're the key drivers of performance for the benchmark. So a high level on the chart implies relatively cheap, and a low level implies that group, the big stock group, is relatively expensive. So you can calculate this in a number of ways. You get a similar picture for each method. We also show the relative 1-year forward performance of the big stocks at each, had you invested at each point in time. So in the early 90s, you can see the big stocks were fairly interesting on a relative basis, not dirt cheap, but they were okay. They went on to outperform substantially, driving a large re-rating, and ended the decade very expensive. Then following the GFC, they were basically back to being relatively cheap, following some very poor performance in that sort of 2010 cycle, as we saw, where the index was one of the worst performers over that cycle. And then they started the cycle again. Off they went again through the last 7, 8, 9 years. And they're not quite today as horrifically expensive as they were in 99, but they are broadly expensive nonetheless. And it's important to note that this isn't just about big tech and AI and all the rest of it. This is Walmart, the well-known US retailer. Here we've plotted exactly the same chart for just Walmart, as opposed to all the big stocks in the group. This is just Walmart, and you see a very similar pattern. If you can cast your mind back one slide, in the mid-90s, Walmart was relatively cheap. Then it becomes very, very expensive. People forget that in 1999, it wasn't just about tech either. Walmart itself was the 5th largest stock in the S&P in 1999, trading at nosebleed levels. It then round-tripped, as most of the other big stocks did, getting cheap again in 2010, 11, 12, before repeating the pattern. It's a great company, no doubt, as it was back then, but now once again is priced for perfection. So it's not a good recipe for returns over the next cycle. Going back to what are our options as global investors? Well, here they are. This is a map of all the stocks in the world, 3,000 or so dots. This is called a UMAP, a Uniform Manifold Approximation and Projection. It's used for dimension reduction. for all the math geeks in the audience, I'm sure there are many of you. If two dots sit next to each other, then those shares or those businesses likely have a lot of common drivers. Very simple. If two dots are very far away from each other on the chart, they don't have many common drivers. So the map is a way to visualize risk or how correlated two assets are. That's why if you color the dots by region, you see how important being a global investor is to risk management. The US you see there in yellow, all bunched together, and Japan in green off on the other side. And you can effectively, in my opinion, think of this map as the most diversified you can be in equity land. You hold basically a little bit of everything. Now look at the same map with the circle sizes reflecting the weights in the index. So this is no longer a diversified portfolio. All the risk is clustered in just a few areas. The US exceptionalism theme coming to the fore here. And these areas, as we sort of talked about earlier, don't really stack up quite as well as they used to. The benchmark now looks both expensive and correlated, fairly high risk proposition. And this tallies with the observation made around the level of frothiness and speculative activity we're seeing in the world today. What does a better construct look like to us? Well, it's one in which you retain concentration, so you need big circles, but you do so on the basis of rationality. You look for a discount to underlying intrinsic value, skewed positive real return potential, while retaining diversity across the whole global opportunity set. So the gray dots here reflect global's positioning in that regard. A quick example, portfolio, Nintendo. We like Japan. There's lots of interesting things happening in Japan, corporate governance improvements, reasonable valuations, cheap currency. Nintendo strikes us as a good store of long-term value here. It's well managed, has enduring IP. One interesting data point is that more than 40% of top-selling games of the last few decades have come out of Nintendo's creative engine, which is an incredible stat. We think growth and margins will move higher over the next 5 to 10 years due to a whole bunch of factors which are kind of new to the company, including standardization of chips, which makes hardware development much less costly and risky. They used to develop their own chips or design them at the very least. And it opens the platform up for more third-party developers to more easily put games onto the platform. Digitization of games is very margin accretive. And probably most importantly, we think they will increasingly diversify into other multimedia adjacencies. So on the latter point, it's interesting to compare to Disney as an example of how valuable IP can be monetized in different ways. Disney is a real shining light in terms of monetization of IP. We know excellent IP drives a core set of consumer enthusiasts. Now, it's hard to quantify enthusiasts, but let's say the number is captured for Disney by the Disney Plus and Hulu subscribers, and for Nintendo by the number of regular players of Nintendo games. And if you use that method, Disney has roughly 2 times more enthusiasts globally than Nintendo, roughly. But if you look at the enterprise value of Nintendo, it's about 20% of Disney's enterprise value. That's the market cap of the company, effectively. So why is Disney or why is Nintendo so much lower in terms of the value ascribed to the company? Because Disney is a master of monetization. Disney extract much more revenue per enthusiast per year than Nintendo. Roughly 4 times as much. So how does Disney achieve this? They use many, many more verticals, merchandise, theatrical window, ad tiers, video on demand, theme parks, cruises, etc. Nintendo's 95% games in terms of its revenue. So there's lots of opportunity for Nintendo to broaden that monetization of its IP if it wants to, which means there's lots of optionality in the business model that, in our view, is not embedded in the price of the shares today. It's a balance, of course. One can over monetize, as Disney has done from time to time, but a measured approach should lead to both enduring IP and a good growth trajectory for the company. So we like Nintendo, as well as an eclectic mix of other companies worldwide. We like that in a frothy environment, there's still plenty of ignored ideas, meaning we're able to identify shares that offer, I would say, a mid-teen-ish return across a range of sectors and geographies. I think mid or even low teen US dollar return will turn out to be exceptional over the next cycle versus what I think the indices can likely achieve. So let's run through again. It's been a tough cycle, but not one we expect to repeat. Why? Well, taking advantage of my mispricings is the lifeblood of what we do. Mispricings, in our view, are not going away. I would argue they're becoming more pronounced, not less. Indeed, today's market looks quite dislocated in that regard. We haven't hit the highs of previous cycles during the last cycle, but we're confident that the engine's still firing. We can see that in the data, and we're now seeing better outcomes in the way the ideas come together through the portfolio construction, which, as I mentioned, we'd worked hard to improve. In the extreme environment, the extreme environment that we've seen over the last cycle, one in which the index was one of the very best portfolios you could have built, I think that's very unlikely to sustain. So our main advice is, as mentioned at the start, be cautious. Speculative activity is elevated across asset classes, which is not a great recipe for above average forward cycle returns, and the capital's crowded into a few areas. So you end up with high and concentrated risk without the commensurate return to compensate. So beware of systemic risk, beware of beta. In our industry, we typically think of the index as the low risk proposition, because it's meant to be a broad reflection of kind of a bit of everything. And any deviation from the index, the benchmark, in, say, active funds is considered an increase in risk, term tracking error. Today we're seeing, I think, far more absolute risk accrue to the indices, so one needs to look to so-called active portfolios to find risks that are both better rewarded and more diverse. That's it. Thank you, and I'll hand back to Alicia.
Graeme, thanks so much for that update. And we're going to launch now straight into some Q&A, right? And right at the top, I've got to ask you, what triggers the change in environment from a US-centric one to something else?
I think it's a good question in the sense that you saw on that UMAP chart with all the different bubbles, just how much market cap has gone to the US. The narrative, the theme is very much US exceptionalism. I think there's at least as many reasons to be cautious on the US asset prices as there are reasons to be excited. Example, so investors cheer the potential long-term benefits of improved government efficiency. That's Doge and Elon Musk and all the rest of it. But maybe ignoring the pain necessary to get there. So one man's costs, another man's revenue. So if you're going to cut costs, you're cutting revenue as well, you're cutting GDP. In addition, while efficiency is hugely positive goal, if Doge doesn't or can't deliver substantial savings, the debt issue in the US will be laid bare for all to see. If not even Elon can fix this, ergo it must be unfixable. Ergo the treasury market starts to quite rapidly. So that's one way you could see this theme unraveling. Another way, investors cheer the America First policy of reshoring primary industry. But it basically would be ignoring the atrophied domestic skills base and the fact that differentiated expertise and skills partnered with global trade has really been the key productivity driver, not just recently, but over the whole of human capitalist civilization. So you're basically reverting to a less efficient state by doing what they're trying to do. And third, a lot of investors cheer the prospect of bringing billions of state-directed capital back to the US and having that marked for US domestic investment, but maybe ignoring the potential or the likely outcome that other states around the world will have to do something similar and bring their own capital back and focus their own state capital on their own economies. And that's more worrying for the US than most other nations, given the US is more dependent on foreign savings than most other countries. Japan, for example, would be a big net beneficiary of that on the other side. Most Japanese savings go off and find return in places like the US. If Japan said, no, look, we're going to take those savings and direct on our own economy, that's a big suck from the US and back into Japan. Finally, there could be some other triggers. So if there's a resolution, for example, to the Ukraine conflict, that would trigger potentially a big EU rebuild akin to the East Germany rebuild boom that we saw after the Berlin Wall fell. That would be another big suck of investor capital out of the US. So there are a lot of different ways that you could see that narrative changing, and it's very, very one-sided.
Yeah. In the interim, you've been quite emphatic about the fact that we're looking at mispricings getting larger in markets, getting more pronounced as well. A question on that front is, wouldn't technology work to bring that down?
Well, I mean, that's been the kind of common perception, I think. But tech's a double-edged sword. On the one side, you get better access to data, analytics, etc., and that should make investors better. But humans are ultimately influenced not by data or truth, but by narrative. So this is a little bit off piece, but if you think about how humans evolved, one way we sort of became the dominant species on the planet was to cooperate in large numbers. And one of the reasons we can do that is we have a strong tendency to believe in stories en masse. So example, countries, we tell a story to ourselves around nations and countries. Being American, British, South African means something. And it's a story that binds millions of people together, such that they do strange things like fight wars as one, putting their own lives at risk for the sake of a nation which itself has no real meaning. It's sort of a fiction. Money's another story, and we all believe in paper or digital bits have value. Bitcoin, Fartcoin, etc., etc. So if enough people believe, then it becomes so. And this ability to cooperate on the basis of narratives is how humans basically killed off Neanderthals and other rivals by coalescing together around a common cause and being able to believe in a narrative. In markets, the narrative is therefore king. And rather than muting its impact, technology has amplified the narrative. So through social media, a story about a company, an industry, or a theme is spread, and it magnifies far more quickly across echo chambers than at any time in the past. And I think this is having a substantial distorting impact on markets. You get bigger bubbles, and you get much more internal mispricings as a result.
Yeah. So before I let you go, Graeme, very quickly, how are you using technology? How are you using AI and the evolution that we're seeing on that front to supplement your investment process?
So 30 years ago, investors used to send away for large books containing company descriptions and financial data and valuations, etc. And then the access improved to that data via the internet. All the data we'll ever need through our fingertips. Then access to management changed through video content and whatnot. And now we have AI allowing us to more quickly access data and summaries of long transcripts and better search through our own library of research. All these improvements build on what's gone before. That makes us more efficient and allows us to focus more time on asking the right questions and delivering insights to clients. AI, or more accurately, large language models and generative AI, is basically another step in that evolution. We've got a very large tech team per unit of AUM in an absolute sense. And as a firm, we've always been obsessed with finding real insight and edge. So we tend to be at the front end of developing these tools in that regard. So we're utilizing it as much as we possibly can in screening, research, portfolio construction, and we'll keep pushing to see how far we can take it.
Well, Graeme, we're going to have to leave it there. Thanks so much for having joined us today. And ladies and gentlemen, Graeme Forster is, of course, one of the managers who directs client capital at Orbis.